We have officially crossed the event horizon. For months, we warned that the silver market was operating on borrowed time, that the price displayed in New York was no longer real, but a paper illusion maintained by leverage, algorithms, and contracts that had nothing to do with physical metal. We warned that when this system failed, it wouldn't unwind slowly. It would snap. Today, Monday, January 12th, 2026, it snapped. The dam didn't crack. It disintegrated. Look at the chart. Don't glance at it, study it. Silver surged to an all-time high of $84 on the Comex before pulling back slightly to around $82.79. That's nearly a 4% move in a single session. But if you're only watching New York, you're missing the most important data point of the day. While Wall Street is staring at $82 debating resistance, double tops, and excuses to sell, the Shanghai Gold Exchange fixed silver at $91.13. Read that again. $91.13. There is now a $7 spread between Western paper silver and Eastern physical silver. This is not an arbitrage opportunity. This is a structural fracture. This is the physical market declaring that the paper market is no longer credible. Comex is saying silver is worth $82. Shanghai is paying $91 for delivery. Which one sets the real price? The market with leverage or the market with metal? Physics always wins. If New York stays at $82 while Shanghai pays $91, traders will buy paper in the West and sell physical in the East until Western vaults are emptied. This is how squeezes begin. This is how pricing mechanisms die. Now look at the price action. Silver opened at $80.69, dipped briefly to $79.95, and then something broke. The price didn't rise, it jumped straight to $84. That kind of move doesn't come from retail buyers or technical traders. It comes from forced buying. We've seen this before. March 2022. Nickel. A massive commercial short was caught offside after a geopolitical shock. Price went vertical. The exchange failed. Trades were canceled. Today's silver chart shows the same fingerprint. That vertical green candle is not momentum. It's a crime scene. Somewhere inside the system, a large short, likely a bullion bank or industrial hedger, ran out of collateral. Short from the $70s. Their risk models failed when Shanghai printed $91. The clearing system took control and executed forced buys. It bought at $81. It bought at $82. It bought at $83. It didn't stop until $84. Now look closely at the candle. Yes, there's a wick at the top. The media will call it profit-taking. They'll say the rally failed. That's false. That wick is desperation. It is the last stand of short sellers defending the $85 level because they know that if silver closes above it while Shanghai holds $91, insolvency follows. So they dump paper contracts they don't own, trying to scare holders out. And yet after all that selling, the candle is still green. In December, price smashes stayed down for days. Today, they bounce back in hours. That's the suppression algorithm losing effectiveness. One more critical signal, the Monday gap. Gapping through an all-time high at the start of the week means pressure built while markets were closed. The Shanghai price, physical shortages, and industrial demand accumulated off-screen, then detonated at the open. This creates panic for anyone sitting in cash. The $75 pullback they were waiting for may never come. That fear of missing out fuels the next leg higher. But understand this, in vertical markets, volatility is a weapon. A sharp flush, even to $79, would not invalidate the breakout. It would be a back test. And with a $7 Shanghai premium, that back test may not happen at all. You are no longer trading a range. You are living through a currency failure. When silver hits $84, don't think silver is expensive. Understand that the dollar is breaking. The silver chart is just the inverse chart of fiat credibility. And today, Comex credibility is collapsing. While traders were watching candlesticks in New York, a very different panic was unfolding behind closed doors. This is where the paper game ends and the physics game begins. To understand why silver isn't collapsing back to $60 and why $84 is acting like a magnet, not a ceiling, you have to stop thinking like a trader and start thinking like a procurement officer at Samsung or Tesla. They don't care about charts. They care about one thing: keeping the assembly line running. Samsung has already committed billions to solid-state battery production. These batteries rely on silver-carbon nano-composite anodes. The factories are built. The tooling is installed. The supply contracts were signed years ago under one fatal assumption: that silver would be available. That assumption died this weekend. When Shanghai fixed silver at $91.13, industrial buyers instantly understood what it meant. Physical metal was flowing east. Unallocated silver was being pulled out of Western vaults to capture the spread. If you are responsible for sourcing silver and you hesitate, your factory stops. If the factory stops, deliveries are missed. If deliveries are missed, stock prices collapse. And market share is lost to competitors who secured supply early. So you don't wait for a dip. You bypass the exchange. You call miners directly in Mexico and Peru. You offer above-market prices, $85, $90, for concentrate shipped straight to private refineries. No Comex, no London fix. This is ghost supply. Metal that never touches public exchanges. Metal that vanishes from visible inventories without warning. To the outside world, supply looks like it's disappearing. In reality, it's being privatized by industry. This is where traditional economics fails. Analysts assume higher prices reduce demand. That logic works for luxury goods. Silver is not a luxury. It's a strategic input. Run the numbers. At $60 silver, the metal in an EV battery might cost $100. At $84 silver, it might cost $135. That difference does not stop a $50,000 vehicle from selling. But without silver, the vehicle cannot be built at any price. So demand doesn't fall as price rises. It accelerates. Fear of unavailability overwhelms cost. Samsung would rather pay $100 an ounce and keep production alive than pay $80 and shut down a factory. That creates a hard industrial floor under the market. Banks can dump paper contracts. They can smash futures prices. But they cannot print silver atoms. Samsung needs atoms. Tesla needs atoms. Solar manufacturers need atoms. And the atoms are going to the highest bidder, which right now is Shanghai. This effectively puts a put option under silver. If the price dips to $78, industrial buyers step in aggressively. To them, it's a discount on survival. And that's before we even factor in geopolitics. Modern warfare is electronic warfare. Drones, missiles, satellites, all silver intensive. The U.S. sold its strategic silver stockpile decades ago. If tensions escalate, the Pentagon becomes another price-insensitive buyer. They print the currency. They will pay whatever it takes. Now combine all of this with a final constraint: refining capacity. Silver can't be refined on demand. Refineries have limits. We are hearing consistent reports that major refineries in Switzerland and Canada are booked for months, running 24/7. This creates backwardation, where silver today is worth more than silver tomorrow. It means buyers no longer trust future delivery. The era of just-in-time supply chains ended this weekend. We are entering just-in-case. Inventory hoarding is coming. If manufacturers double or triple their silver reserves, global demand doesn't rise gradually, it jumps violently. That is why $84 isn't a peak. It's the moment industry panicked. In the first phase, smart money moved in silence. In the second phase, industry moved in desperation. Now comes the third phase, the public. The 10% move over the last 2 sessions was the signal flare. It forced millions of people who haven't checked the silver price in over a decade to look up, and what they saw was a market going vertical. This is where the psychology shifts. The question is no longer, is silver a good investment? It becomes, how do I get silver before it's gone? That shift changes everything. We're no longer talking about charts or models. We're talking about human behavior. Over the weekend, global search interest for how to buy silver exploded. Social media flipped from indifference to obsession. Silver stopped being a dead metal and started being framed as the next Bitcoin. This is dangerous territory for the banks because retail demand is price insensitive. Institutional buyers calculate value. Retail buyers chase momentum. When the average person sees silver move from $80 to $84, the dominant emotion isn't analysis. It's fear of missing out. So they act. They log into brokerage apps. They drive to coin shops. They flood dealer websites. And they immediately hit a wall. The retail silver market coins, rounds, small bars is tiny. It depends entirely on large industrial bars being converted into retail products. But those bars are already being vacuumed up by Samsung, Tesla, and sovereign buyers. The feedstock is gone. That's why dealer websites are flashing warnings. High volume, delayed shipping, call for pricing. That last phrase is the most important. Dealers turn off automated pricing when volatility becomes unmanageable. If they sell at $85 and the price gaps to $90 minutes later, they lose money. So they stop selling altogether. This is how silver becomes unobtainium. The screen price might say $82, but try to buy an ounce for $82. You can't. Premiums explode $15, $20, even $25 over spot. That means the real-world price of silver is already brushing $100. At this point, the market splits in two. There is the paper market, where banks trade digital contracts to defend a narrative. And there is the physical market, where metal changes hands at whatever price clears supply. The gap between them is widening, and that gap is lethal to the exchange. This brings us to the most dangerous trap for new buyers, the ETF illusion. When retail interest spikes, most people don't buy physical metal. It's inconvenient. So they buy silver ETFs, believing they're helping the squeeze. They're not. During a physical shortage, buying paper silver is like buying a ticket to a concert that no longer exists. The cash flows straight to the same bullion banks that are short the market. The metal is leased, rehypothecated, and used to suppress price. You are funding the enemy. If you cannot hold it, you do not own it. That rule has never mattered more than it does right now. As physical demand explodes, the Comex faces an impossible dilemma. If street prices hit $110 while futures trade at $82, anyone with a warehouse receipt will stand for delivery take metal at $82 and sell it on the street. That arbitrage drains the vaults, and the vaults are already bleeding. Registered silver, the metal actually available for delivery, is at historic lows. The market is realizing something critical. At $80, there isn't enough silver. So the price has to rise. If there's no metal at $90, it goes to $100. If there's none at $100, it goes higher. Price discovery continues until supply appears or demand breaks. But who is selling? Long-term holders aren't. They held through the bear market. They understand the fundamentals. They're not dumping insurance during a monetary fire. So now you have industrial panic, retail stampede, and entrenched holders all aligned in the same direction. This is the anatomy of a vertical melt-up. But there is one final warning. Do not use leverage. The banks know retail has arrived. They will engineer violent flushes to trigger stops. You can be right on direction and still get wiped out. Physical metal doesn't care about flash crashes. An ounce is still an ounce. The retail tsunami has made landfall, and it's only the beginning. Once an asset breaks its all-time high, everything changes. There are no resistance levels above, no historical ceilings, no maps. Silver is no longer trading inside a range. It has entered price discovery. So the question becomes simple. Where does this stop? Is $84 the top? Is $100 the top? To answer that, we have to abandon the dollar entirely. The dollar is no longer a reliable unit of measure. Pricing silver in dollars right now is like measuring distance with a rubber band. The measurement stretches as the currency weakens. Instead, we look at relative value. We look at gold. Gold is trading near $4,580. It is behaving like an anchor. It is the metal central banks trust when confidence collapses. And historically, gold and silver have always moved together, not in price, but in ratio. For thousands of years, the monetary gold-to-silver ratio hovered near 15-1. From the Roman Empire to the U.S. Constitution, this ratio reflected geological reality and monetary function. In the modern era, that ratio was distorted. It blew out to 80, 90, even 100-1, because silver was treated as an industrial byproduct, not money. Today, with gold near $4,580 and silver around $82, the ratio is roughly 55-1. That ratio is collapsing, and it is collapsing fast. If silver were simply to revert to its historical monetary relationship with gold, without gold moving higher, silver would trade above $300 per ounce. That's not speculation. That's arithmetic, which means something critical. At $82, silver is not expensive. It is still deeply undervalued. This is the catch-up trade. When gold becomes too expensive for institutions and individuals alike, capital flows into silver. Silver is the leveraged monetary metal. It is the pressure valve. This is why the move to $100 is not a question of if, but when. Shanghai is already at $91. The street price is already flirting with 3 digits. The paper price has no choice but to follow. And when silver crosses $100, psychology changes again. Round numbers matter. They anchor human behavior. Silver above $100 will dominate headlines. It will be framed as a crisis, a bubble, a speculative mania. That moment is both maximum opportunity and maximum danger. Because this is where people start thinking about selling. And here is where most will make the fatal mistake. If you sell silver for dollars, what are you really doing? You are trading a scarce, hard asset for a currency that is actively collapsing. You are stepping off the lifeboat and swimming back toward the sinking ship because the ship still has lights on. The dollar is not the destination. The dollar is the casualty. We are in the early stages of a currency reset. Sovereign debt levels are unpayable. Central banks know this. History is clear. When debt bubbles collapse, currencies are sacrificed. In every currency failure, from Weimar Germany to Venezuela, those who sold gold and silver too early paid the price later. They became millionaires on paper and poor in reality. So what is the correct exit? You don't sell metal for paper. You exchange metal for productive assets. This is the ounces to acres strategy. You trade silver for land, for energy assets, for cash-flowing businesses, for things that produce value in a post-fiat world. Timing matters. Right now, it may take thousands of ounces of silver to buy a quality property. In a full mania, that number collapses. Hundreds of ounces, not thousands. That is the trade. But we are not there yet. At $82, silver is still leaving the launchpad. The volatility ahead will be brutal. Banks will attempt counterattacks. There will be violent pullbacks designed to shake weak hands loose. Ignore the noise. Watch the flows. Is Shanghai backing off? Are industrial buyers slowing? Are physical premiums collapsing? No. The bridge behind us is burning. There is no return to $20 silver. That world is gone. We are entering the era of resource competition. and silver sits at the center of it. What happens next is not driven by charts. It's driven by behavior. Once the public realizes silver is scarce, logic gives way to urgency. This is the moment when people stop asking if they should buy and start asking where they still can. Coin shops don't run out gradually. They go from limited stock to nothing available overnight. That transition has already begun. When shelves go empty, price discovery accelerates. Not on screens, but in the real world, where metal changes hands. This is why premiums detach completely from spot. The paper price becomes irrelevant. Availability becomes the price. At that point, Comex faces an existential problem. If futures say $82 while the street clears at $110, delivery requests explode. Every ounce removed from registered inventory tightens the noose. The exchange doesn't fail loudly, it bleeds out. And the banks know this. That's why volatility will increase, not decrease. Sharp drops are designed to scare, not to reflect reality. This is why leverage is fatal here. You can be right and still be wiped out before the move completes. Physical metal doesn't get margin called. It doesn't care about flash crashes. It simply exists outside the system. As the mania builds, silver won't just be viewed as an investment. It will be viewed as protection. That is when governments take notice. Resource nationalism follows. Export controls, hoarding, strategic priority. By then, the opportunity to get positioned is gone. All that remains is the repricing. Eventually, the trade is not silver to dollars, but silver to real assets, land, energy, productive systems. We are not at the end. We are at the beginning of price discovery. The paper era ended Sunday night. The physical era began Monday morning, and it does not reverse.